Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Tripp Jones joins us today from San Francisco. Tripp is a general partner at Uncork Capital, a renowned seed stage fund that has made investments in Fitbit, Poshmark, and Postmates, to name a few. Prior to Uncork, he was a general partner at August Capital, where he made over 30 investments, including Bark, HipCamp, and Wattpad. In total, a dozen have gone on to exit or be valued more than $1 billion. Tripp, welcome to the show.
Thanks, Nate. Glad to be here.
Awesome. Can you give a quick 2 to 3 minute background in your path to VC?
Yeah, absolutely. Mine's atypical in the sense that they're all atypical to VC, but mine's really weird because I wanted to be a VC ever since I was 8 years old. I grew up in the San Francisco Bay Area. Obviously, that had a big factor in my young interest in the venture industry. All the moms and dads in town growing up, the ones I really admired were what I now would call an entrepreneur, but what I called an inventor at the time. I was a weird, anxious little kid and I always thought I had to be an inventor. And then my basketball coach when I was in second grade, he was the founder of one of the old school Sand Hill Road firms called Interwest Partners, was like, let me tell you about what I do. You don't have to be the smartest guy or gal in the room. You just have to figure out who the smartest, guy or gal in the room is, and then give them money. And that's what we do in VC. And I was like, that makes so much more sense to me. I'm going to do that. And ever since that, and I was fascinated with the industry and kind of became a student.
Even at 8 years old. Wow.
At 8 years, I remember it clicking night and day click. And I just had this wave of peace washed over me. I'm like, oh, that's what I'm going to do when I grow up.
I think you're one of the lucky few that has it figured out at that age.
Totally. I mean, it was completely up and to the right from that point on. I never got distracted or have any other interests. No, it was an interesting, weird insight, but always geared for it.
So you worked at August Capital, transitioned to Uncork. What prompted the move and what's the thesis at Uncork?
Yeah, it's a good question because I spent more than a decade at August. And August is this long-standing kind of white shoe Sand Hill Road Series A firm. And at the end of the day, the traditional Series A Sand Hill world is getting totally disrupted. The last 5 years was, I'm trying not to use the word disrupted again, but it really disrupted that existing industry. When I started as a 20-something-year-old early stage VC, there was 20 or 25 firms that you could conceivably go to raise your $6 to $10 million Series A. And, the vast majority of them on, 1 3-block stretch of Sand Hill Road in Menlo Park, California. You can go to Union Square in New York or Foundry in Boulder, but those were the exceptions. And, what's happened in the last 5 years has been amazing. Essentially, half those funds have gotten so much bigger. They're not raising $300-400 million funds. They're raising $3-4 billion funds. They look like global asset managers and, they're investing anywhere across any part of the capital stack, equity, debt, anything and everything. Frankly, they look more like BlackRock or Blackstone than kind of the cottage industry that was venture, even 10 years ago. The other half really didn't, they were very good, had a long history of success, really didn't want to evolve. And, at the end of the day, I think they're kind of all going to go away, eventually. Put a little asterisk next to benchmark. We'll see how long they can carry it because they're so exceptionally good. But structurally, they're at a disadvantage. So what was next? And what I saw emerging in the seed industry, especially again in the last decade, but really the last 5 years, was the institutionalization of the seed industry. It growing up, it getting bigger, more serious, buying more ownership. And even though there's 1,500 seed funds out there, I mean, every time I look, there's my number is wrong. There is 15 to 20 that occupy this kind of lead check institutional seed industry. They're buying, 10-ish% of companies at their first $3 to $5 million institutional seed round. And I'm like, I have seen this play before. It feels so much like the Series A industry did. I think it's where most of the alpha is going to be in this industry over the next decade. I think if you want kind of a safe, net 2 or 3x return, go to the big guys. They're great. They're really good at what they do. If you want to see 10, 15, 20x plus funds, it's going to come out of the seed industry. And that's part of the market that's most exciting to me. That's where I wanted to play. Uncork being kind of one of the elite, seed funds out there, founded by Jeff Clavier, who's been a friend and mentor for a dozen years. Co-managing partner is Andy McLaughlin, who I think is absolutely the best enterprise seed software investor in the world. He also happens to be one of my best friends. And so when they kind of early in 2021, when they said, hey, there might be an opportunity for you to come join us, it was sort of a dream come true. And I jumped on it pretty quickly.
Yeah, you're in good company there for sure. So can you tell us about the thesis at Uncork and what you guys are up to?
Yeah, so we are and have always been a generalist fund focused on the early stage technology market. Where our focus really lies is in this seed category where, we're investing $1 to $3 million or 10 to 12% ownership in a company. A generalist fund, that doesn't mean we do everything. There's 4 GPs, Jeff and Andy, as I mentioned before, and Susan Liu, who joined us shortly before me from Scale Venture Partners. We all have our kind of zone of specialization where we want to be known for our specific verticals, what we do very, very, very well. So when you go to a great super angel or an advisor or another entrepreneur, or even, one of the larger multi-stage firms, like, hey, I have a dev tools company, I'm ready to raise my seed round. I want to make sure that we are on that list like every single time when you're getting your 3 to 4 intros. So if dev tools, it's going to go to Andy McLaughlin. If you're not getting an intro to Andy, you're probably being advised incorrectly. And that's the way we focus it. We feel like we kind of cover 80, 90% of the market with our different specialization groups, but we'll pass on stuff just because it's not perfect for us.
I'm curious, given that you started at August, you transitioned to Uncork, going from Series A to seed. What is the muscle that you either had to learn or unlearn as an investor, changing stages? Because there is a difference there. And I'm curious from your perspective, how you've had to reshape your mindset moving down market.
Yeah, I know it's down market, up market.
Who knows, right?
Yeah, earlier market, definitely earlier. I agree on that. It's a good question. And it's funny because I actually started my investing career in my mid-20s at a growth equity firm focused on internet and software investing called Spectrum Equity. And I like a great place to become like a really good fundamental investor. And when I went from growth to Series A, I had to like break all those good learnings and like kind of throw away all my logic. And I've had to do it again, going from Series A to seed, though the jump wasn't quite as dramatic. To be honest, when we get involved at Uncork, it's usually 6 to 12 months before when we invest at August. And, but those companies are in very different places. There's usually no real indication of product market fit yet, which is kind of the hallmark of a Series A investment. Early product market fit, clear product market fit. Oh my gosh, you have real numbers. I have 1, 3, 6 months of data. This is working. Let's jump in it and kind of help this company inflect. On the seed market, it's a different mentality. I like to say, we step back, we kind of look for these big and novel new markets. What piece of technology has evolved that a new 10, 20, $100 billion market can be built. We think about business models that might fit into that big and novel new market. And then we look at teams attacking big and novel new market. And for whatever reason, when things are right to be different, there's always 3, 4, 5 teams going out at different parts of the world, came to the same conclusion with very different perspectives. And we go out, identify those teams and try to pick the best one. When we miss, it's usually because, not that none of our teams are not great. They are. When we miss, it's because we typically get the big and novel market thesis correctly, but we pick the second or third or fourth best team. And when that happens, there's a huge power law in venture and kind of all your returns come from picking the very best team. And, we're happy to do that. And then once that best team emerges, it's beyond us. That's then the time for the Andreessen Horowitzes and Sequoias to step in and fund them at kind of any valuation necessary with as much capital as they can bear. And I just love going in and making those bets. They are bets at the end of the day before it's obvious to the rest of the market.
Mm-hmm. So you've invested in 12 unicorns. Is there a unifying thread among the founding teams and the opportunities that you've identified that have reached the upper echelon of that power law?
It's funny. Like, I get asked this question a lot. I think about this question a lot because if I had like a really good quantifiable answer, like, shouldn't I just be able to invest in only unicorns from seed stage? The short answer is hard to quantify. I actually just listened to an interview that Keith Raboy just did, and he was asked the exact same question. And the way he defined it was he said, like, he looks for a spark. For a guy who's about as smart as they come, the way he had to describe it is a spark. Kind of says a lot that it's really hard to quantify. For me, I kind of look for I call it this clarity of vision, almost like these teams have such a clear picture of what the company they're building will look like in 10 years. And it's like they're working backwards. And it's like every day is just like, okay, I have 3,650 days to make this company work to get to my 10-year vision. What do I need to do today to push the ball forward? And it's squishy. I get that. But the unifying theme is like, it's almost like these teams were placed on this earth to build these companies. And I think in their heart of hearts, they truly believe like if they don't do it, it won't be built. Like only they can build it, which, that's debatable. But like that type of confidence and that type of vision is kind of the clarifying theme. It's still really hard to pick because sometimes when you're like pre-product or team of 3 or 4 and you're talking about like the $20 billion company you're going to build, you come off as sort of a crazy person. Like you sound insane. Like it's irrational. And that's like the thing about entrepreneurs I like respect so much is like you have to make a near crazy, 99 out of 100 people are going to say like, you're an idiot. You should stay at your job at Google or whatever. You're going to make that leap. And I hopefully am the one person that's like, yeah, that's a great idea. Here's $2 million. Let's go build it.
Yeah. They're the most exciting founders to back.
Totally. But yeah, there's a thin line between ambition and vision and delusion.
Yeah, definitely. What about the opposite side of the coin? What have been some of your biggest misses and how have they impacted your investing mindset today?
Oh man, I mean, where to start? Like Bessemer Fund has their famous anti-portfolio list. And I'm like, I feel like after doing this for, a dozen years, I'm like, my anti-portfolio list is almost as long. They're all over the place, right? There's examples where like I had true religion and I just couldn't convince my older partner. I remember being obsessed with Airbnb in my 20s and like falling over backwards to try to convince my old partnership. Back in the Spectrum days, it was so not a fit to take that company seriously. And I was told to put my office on Airbnb to get some productivity out of it by my boss. I remember ones where I finally got I pulled my partnership through and I just lost the deal because I just got out hustled and out competed. And I viscerally remember losing the Oculus Series A to a very talented syndicate in Spark and Matrix. And like how crushing that was. And how I vowed to myself that I would never lose another fair fight on a term sheet again. And I don't think I have since then. And then there's ones where like I got the green light, kind of looked into the abyss and didn't pull the trigger. And the one that stands out just kind of off the cuff is I worked with the founding team at Roman when one of the founders was the head of growth at one of my portfolio companies, Bark. Like I knew how this guy, Rob Schutz, incredibly talented, kind of marketer, growth oriented, growth hacker, whatever you want to call him. They saw this new market, which now turned into Roman, started around actually erectile dysfunction pills, which is kind of a little bit of an awkward category, but one that because of its awkwardness, there was an opportunity there. And I did all the work. My partnership was super supportive at August. And it was a summer of Me Too. And it was the one time I didn't do an investment for like an emotional, personal reason. I'm like, I don't know if I want to fund a boner pill company, in the summer of Me Too. And I'm like, I thought it was a smart move, even though I thought it's a medical need for a lot of people out there and just general healthcare, personal healthcare for folks with an exceptional team with a big vision. And I passed just because of that. And I kick myself over that emotional, ego driven, like protect my reputation, and I kick myself because I don't know what that company is going to be valued at the end of the day, but that was a $3 million seed round on a company. I think the last round was $5 billion post, that one hurts.
That's a tough one. So you've made a few investments in the consumer space, and there's a popular belief that consumer VC is dead. What do you find attractive about consumer today? And what would you say to people that are skeptical about the future of consumer in general?
Well, I hear this a lot. It's kind of a common trope over the last 4 or 5 years, like consumer VC is dead. And I've watched a lot of my consumer brethren pivot to like vertical SaaS, which, they really gave up on it. But a lot of them have really pivoted in like Web3 and crypto because there's some similar dynamics in the markets. But at the end of the day, like 70% of the US economy is consumer GDP. The amount of consumer spend in the US economy is like the greatest economic engine in the history of the world. And to think the category is dead is just like silly. We're between trends. Sure. I wouldn't say I'm inspired every day when the consumer tech market, but you only have to just wait around for only so long before the next great consumer deal pops up. And I hopefully will have a prepared mind and ready for it. In terms of like, what do I do to get that prepared mind and think about it? I do a couple of things. One, I'm constantly focused on like where the cultural zeitgeist is going. I'm trying to kind of see over the horizon of like where culture is going. I am not the coolest guy in the world. I'm a 41-year-old white man that lives in the suburbs, like call a spade a spade. However, I think you can do that just by like reading a ton. So I like read all the typical business stuff. And then I like sit there and like read the celebrity blogs and I read like cheesy magazines and I read a ton of science fiction. That's like one of my like secrets is I probably read like one science fiction book a month because it always just has me thinking about like what the world will look like in the future. Just so like when I see it, I'm kind of ready for it when the future is today. The other thing I focus on and I try to be really mindful of, and again, it's a little unnatural for me, is 80% of the consumer economy is powered by women. And it's essentially women between the ages of 13 and 65. And I think I had this prototypical woman in my mind, and she doesn't live in San Francisco or New York or LA or London or somewhere, metropolitan and swanky. She lives I always put her in Cincinnati, Ohio. It's kind of like, what's the most average place in America? Now it's like Cincinnati or Boise, Idaho. She makes 75 grand a year and I invest at different points in her life. When she's a teenager, early 20s, I think about like how she interacts with her friends and where she spends her time. And it brought me to investments like Wattpad, which is like a social network for writers and readers. And it's predominantly younger women. Later in her life, when she's married and starting a family, it's a big time where she changes her consumer behaviors and completely shifts how she spends money. And it goes towards baby and family and community, and it led me to investments into Lily and Yumi and in others in like that category. And I kind of basically follow her up and down her life cycle. And it really can't just be products for me or my wife or whatever. It's got to be products for like the masses of American women that basically power the consumer economy.
How do you delineate between falling into the trap where this is where you think the future is going and you think this is, using the example of the Cincinnati mother, you think this is what she needs when she has her first child, for example? How do you delineate between this is what I think the mother needs versus like this is the reality of what they actually want?
Yeah, it's a good question. I think a lot of VCs have really, really strong opinions of like, they're so self-assured that like, I know what's best. Mm-hmm. I understand the technology. I know what's best for the world. Like I'll call the future the way I see it. I try to listen a lot more. I try to travel a lot more. I have 3 young kids and my wife and I like to get out and about and travel. Even during the COVID times, like we're going to go move somewhere for 2 weeks and work from somewhere else. I mean, it's kind of weird, but like we'll utilize a lot of babysitters. I'm always like, I know this is awkward. Can I look at your phone? And people, ask a 20-year-old woman, like, can you look at your phone? Like, it's going to be a weird conversation, but like, I want to see what's on her home screen. I want to see what she's doing. I then just kind of pepper her with like, have you ever used the RealReal? And no, 20-year-old babysitter in Idaho or Ohio has ever used the RealReal. But you're like, have you ever used Poshmark? And they're like, yeah, I love Poshmark. Like, that's the place where I got my prom dress or whatever kind of important thing to her. And so just listening to those women, reading as much as possible and kind of being intentionally humble about I am not that person. I cannot tell that person who to be or what to like. Like listen to what she actually wants, how she actually is spending her time and her money. That's I think the key to it. At least it's the one that served me well for the last 15 years.
Do you have a framework that you use when you're evaluating a consumer startup or a process that you follow?
Yeah, I mean, there's a couple. I oftentimes these days invest pre-launch, but there's indications of whether or not there's kind of product market fit before there's actually a launch or product market fit. One of my like insights around marketplaces, for example, is whatever behavior this marketplace is going to try to drive. So investors in companies like HipCamp or Turo that my partner Howard did at August, other ones like Poshmark that Jeff did at Uncork, they basically, the behaviors that those companies are driving are actually, everyone's like, oh, wow, like these companies invented a new consumer behavior. I disagree with that. I think people are trying to hack together a new consumer behavior. Like, hey, I have all this extra clothes all of a sudden. I would love to get rid of them. I can drop them with Goodwill, but they're really nice. Like there's value here. How can I do this? And like people start, all of a sudden you start seeing consignment shops and eBay was starting to sell like higher end stuff. And basically people are trying to hack together these behaviors. And a really smart entrepreneur stands in front of this macro change that's occurring, wraps a bunch of software around it and enables a new marketplace. And so watching the way people are trying to hack the behavior before, see like how much friction they're willing to wade through, how much expense they're willing to suffer. And then kind of tells me like, hey, is this thing going to work or not? And if there's thousands or millions of people around the world dealing with this pain, you kind of know that if a marketplace comes out there, launches, makes all that pain go away or takes most of the friction out of the system, it's going to work and it's going to work fast.
On that topic, we're talking about marketplaces. Oftentimes they're activating idle supply, which increases the frequency of these behaviors. Maybe it's not an entirely new behavior, but it expands the bubble and it breeds some non-consumption, right? Just due to the ease of friction of the experience. And we see this in Poshmark, HipCamp, Uber, the list goes on. Many investors at the seed stage questioned, what is the market size of these startups? As an investor, how do you think about market sizing today to make sure that you're not potentially missing out on an opportunity that seems niche to most?
Yeah, it's a good question. And this is another one that's hard to quantify. Everyone's always like, how do you quantify it, right? Because as all our venture funds get bigger, as we have to be able to return an entire fund with a $2 or $3 million investment, if not multiples of fund, making sure we invest in big markets is really, really important. However, with some of these kind of new behaviors that we're helping, if not create, but helping kind of take the friction out and unlocking the potential of these new behaviors, they're hard to quantify because let's use HipCamp as an example. And so HipCamp is a marketplace for people to essentially rent out their private land, open space for camping, other outdoor recreation opportunities. Before HipCamp was around, people did this. You could go out and knock on a rancher's door or a farmer's door and be like, hey, can I rent your back 40 for a wedding or go fishing or hunting or camping on it? You could do it. It was massively friction filled. But if you try to quantify the size of that market, be pretty small, it's pretty niche. People are like, well, that's a lot of pain. I could just go to a state park and camp next to, the other 57 families wanting to camp, or I could wake up at 6 a.m. and try to reserve a spot in Yosemite or Yellowstone for the weekend I want to go camping. And so that was so much easier that's where the vast majority of the market went. And so that was a big question for a lot of people. This doesn't seem big enough. But the other thing about these markets is they basically invent the markets too. So maybe renting private land to go camping or outdoor recreation was $1 billion market before HipCamp. Now that HipCamp's shown that it works, it's tens of billions of dollars. It's hundreds of billions. If you include the whole world, it's really, really giant market. 60% of the United States is privately owned land, not built up houses, privately owned land. That's providing access to arguably one of the biggest markets out there, and then I don't think anyone thought that when the company first started. And so it is hard. And you basically have to hold a really fine line to be okay, can this be big enough? But the big variable that you need to really get your head around is, what if this works? If this works, will it change the market? Will it change consumer behavior so much that it expands a market 2x, 10x, 20x, whatever X to be a big and important company? And that's something that I wrestle with constantly.
Where do you see investors often getting market sizing wrong?
I think a lot, what category, where they focus on. I think, and I've done this before, and I'm certainly not omnipotent. I think it's when consumer VCs usually go wrong when there's a new consumer marketplace or new consumer product that speaks to them where they're clearly the core demo. And they're just like, oh my God, this is amazing. I love this new thing. Everyone's going to need one of these, but it's actually just for 40-year-old dudes in Palo Alto or Manhattan. And they just vastly overestimate the market size just because in their social group, in their kind of community, it's a perfect product, but there's just not that many of them. And that's where I think they miss the most. I'll, famously pick on a Juicero or something like this. Yes, we all need a $600 smoothie maker. Yeah, I get why it was a really cool product, but no one, that gal in Cincinnati, she is not going to buy a $600 smoothie maker, even if it worked, which it didn't.
Yeah. So you spent a lot of time on supply side driven marketplaces. What about them is most intriguing for you as an investor?
Yeah. So, I've had a lot of influence in my life, but the two guys who I have not worked with, but that I kind of look up to and I'm a disciple of is Bill Gurley and Mike Maples, who I think are two of the greatest marketplace investors ever. And Gurley in particular was very focused on supply-driven marketplace, where the hard part, the valuable part was going out and acquiring a bunch of hard-to-access supply. So for him, let's use an Open Table, one of his early hits, where it was hey, if I can go get all these restaurants, which is a pain in the ass, selling to restaurants sucks. I'm going to get all these restaurants. Like, you start using my software, give me their inventory to make them bookable. And if I go deal with the pain of all these restaurants doing that, I will have a very, very sticky supply base. But not just that, like once I get it, I'll spend $1 to make $1 in the next 12 or 24 months, which is not a great amount of capital efficiency. But once I get them, I'll then make $1.50 in year 2 and $2 in year 3 and $3 in year 4. And frankly, have those supply cohorts stay on for essentially ever until you fail with your value prop. And on the flip side, on the demand side, because unlocking that sticky, valuable supply, and we just use OpenTable, we'll use Turo, we'll use HipCamp, we'll use Airbnb. Once someone's gone out and done the hard work of unlocking that supply, the demand almost comes in naturally because it's such a strong value prop that demand just kind of overwhelmingly comes in and you don't have to acquire demand. And so there's a lot of marketplace businesses out there and they're really hard to stand up, which a lot of people know if spent time with them. But I have a very small strike zone for what I look for. I look for hard to access, very sticky supply where, the supply GMV growth will grow over time. If the company delivers what it's supposed to, it will grow over time. Therefore, it's worth the initial investment. And then the demand side comes in basically for free, where because the supply is so valuable, it just comes in like a voracious appetite demand. I mean, the one perfect example of that was Uber, where the demand was so extreme for Uber kind of over the years. It was unlike anyone ever saw. Like, people could not get enough of it. The negative for me on Uber, and August did pass on it before my time, I never looked at it seriously. But the issue I would have had with my current thinking and framework would be, I don't like investing in marketplaces where the supply component is essentially hourly human capital, where people, you're basically like wrangling as much people who are getting paid for their actual hourly labor, into a market, because people do not like that rake being taken off their back. Like, it doesn't feel good. They can feel it. I drove you across town. I made $20. I know Uber made $5. Like, I don't like that. It's not a good feeling. And there's lots of different labor marketplaces like that. And the issue is they do it for a while. It's like kind of a necessary bridge gap in their life. And then they turn off it as soon as they can. And so those marketplaces, they spend so much money acquiring supply, reacquiring supply, acquiring more supply that they lost. It's very, very difficult to build a base of this stable supply that can drive enterprise value over years or decades to come. Now, inanimate object like a car or a piece of land or a house doesn't feel that rake. It doesn't mind being utilized 24 hours a day. It's happy to be utilized fully. Inanimate. Those are the type of marketplaces I really, really like. It doesn't mean I don't invest in people-driven marketplace. If the supply side is people, but it's people acting as a small business, that's interesting to me. Like, Shopify is a hell of a marketplace because it's people on one side, but it's enabling people to run small businesses. My more recent investment in Ubiquitous, which is basically a business in a box for creators, like, it lets creators run their entire business. Yes, they're taking a rake, but like, without Ubiquitous, their small business would be so much harder to run. And those are dynamics where I will invest in people-driven supply side businesses.
How do you get to conviction that the demand will be there for marketplaces where the supply side is hard to capture?
Yeah, again, I can't talk about it. I closed a recent investment in a marketplace business pre-launch last week. I don't know if there's demand there. I'll only know after launch. What I do know is I'm watching that consumer behavior. I'm watching what people are trying to do before this marketplace exists. And they're doing things that like either hard, time intensive, or costly, or at times dangerous to themselves, whether it's like financially or physically. And when I see like almost irrational behavior on the demand side, trying to unlock a behavior, I get comfort that if you kind of do it right, provide a better experience, that demand will naturally flow right into that supply side that you've unlocked for it.
Does the type of supply affect your analysis? So for example, does a supply side that's homogenous, like an Uber, you don't care which driver picks you up, you just want to be picked up, versus a HipCamp where your campsites can be very different. Each unit of supply is different. How does the type of supply affect your analysis, if at all?
I think unique high quality supply is super, super important. I think if you have a totally homogenous supply, let's say you've gone out and acquired, 1,000 generic widgets and you take your 20% rate because you offer widgets. Widgets, again, don't care if you overutilize them. So it works. But then another entrepreneur can come along and be like, wow, there's a lot of demand for the widget market. I'll offer my 1,000 widgets. I'll go acquire 1,000 widgets and offer it for 10% rate. Mm-hmm. And I think it's kind of a death spiral. Like if you acquire unique, interesting supply, you can't be commoditized out. Yeah. So, whether it is a great restaurant or a great piece of land or a really cool vacation property, those are unique pieces of supply. I think that proximity can provide uniqueness. Like a Turo car that's 2 blocks away, that can be unique, though that it does have a potential for some commoditization. I think that's paramount of importance to me. I actually think that kind of the success and hype and just mind share that Uber took in the VC community and the broader tech community, actually, it looked like such an amazing thing to marketplace investors, but it actually like poisoned a generation of marketplace investors and entrepreneurs who are like, I'm going to be the Uber for X. It was such a perfect product market fit based on mobile phones and a moment in time that it worked so well. But fundamentally, it's not a good marketplace fit business, in my opinion. And it's still TBD on like whether this thing can ever be profitable. Yeah. So everyone for a generation was just like, I'm going to do the Uber for X. Like you've heard that 1,000 times. Oh, it's Uber for Y, Uber for X. And every time you're like that, I'm like, it's going to be a pass for me because I don't think it's that good a business.
Mm-hmm. Definitely. So over the past couple of years, we've continued to see records for capital deployment and venture as an asset class. You've said that you think the venture market is underestimating the flow of capital from LPs away from the industry over the next 12 plus months. What are your concerns and why do you think this?
Yeah, no, it's a really interesting time. And as I mentioned early in this chat, like I've been kind of a student of history and a student of venture for a long time. And it's funny, my focus in college was history and psychology, which is not the typical background for most venture capitalists, or CS majors or, real scientists. But I do think this is like the one place human behavior and history really, really matters here. And we always look back like, okay, why is this like 2000 or why is this like 2008? And we're trying to draw parallels. And like every cycle is the same and every cycle is totally different. And this one's a weird one because we've had such a massive 12-year bull market in the venture industry. Like everyone did a lot of the things well because, the rising market just kind of forgave all sins. What's happened though is these traditional allocators, and so it's not discussed that often, but venture funds have LP investors, and those LPs historically have been foundations, endowments of universities, these fund of funds that specialize in it, and these different pools of capital. And everyone's done exceptionally well. But now you kind of read about the Harvard Foundation being $42 billion, these deca-billion-dollar foundations that have like been running up in venture. So much of these endowments are now venture growth-oriented technology, private investing, like 30, 40% of these endowments. And when you kind of look at the way to properly manage endowments, they'll overload on alternative assets. However, their models are not supposed to be that highly concentrated. So we've had this record run up where their endowments are out of balance. At the same time, we've seen a big sell-off in the public markets and public bond markets where the value of those positions in these endowments and foundations have come down significantly in the last 6 months. So we're way overweight venture, and then we're even more overweight venture because the public market. So if we were at 35%, now we're at 45%. So what's happened, the venture industry is full of a bunch of really smart people and really smart firms. They've all kind of been like, we're about to hit a systematic problem in the capital flows in this market. Let's go out and raise as big of funds as we possibly can before we told our LPs that we're going to do it. But we're the blue chip of the blue chip names, and I'll pick on them because they're so good. Like the Andreessens and Sequoias all raised gigantic new funds at the beginning of this year. Andreessen closed on $9 billion, when they weren't supposed to be in market yet. It's one of those situations where like people are like, well, I can't pass on Andreessen because if I pass on Andreessen, I'm out and I won't get my seat back at the table. So it took that endowment that should be 20%, but was at 35%, then went to 45%, now to 50%. Now the board of trustees are screaming, people are worried, and the capital gates are up with the traditional managers. And we've created this perfect storm where there essentially isn't traditional LP capital for new venture commitments right now. If you weren't around for years, didn't message, hey, I'm coming, please reserve me capital, you're not getting funded this year, unless there's not even unless you're spectacular, like it just might be full stop. And you're going to see a huge decrease in new fund formation. You're going to see good funds that aren't great really, really struggle to raise new funds. it's going to be a tough time as this kind of like works through the market. And it takes a long time because even though intellectually you may all say, like, whoa, those big, gigantic venture portfolios are overvalued, we should start revaluing them. You kind of got to wait for your managers to do it. But managers don't like to mark their portfolios down unless like something objectively is going wrong. They try to be like insulated from the public market. So they're going to hold these valuations too high for too long. And it's going to take time. Unless big, new pools of capital come into the market, which I don't really see in mass, like it's going to be a bit of a winter here for 12 to 24 months in the venture capital fundraising market.
What are going to be some of the second and third order effects from LPs pulling back? So funds being able to raise new funds, that's obviously one that's going to affect them directly. But what will the effect on founders be? What are some of the other effects that we're going to see in the market due to LPs pulling back?
I think this realization is coming to, every day. I think more and more of the market wakes up to this and they realize their next fundraise is going to be difficult, even if they're great. I think the first thing that happens is all of a sudden people start slowing their pacing. People have been investing way too fast, in my opinion, over the last several years. Just kind of anything that looks good, feels good, has the right vibe, getting an investment. I think people are going to really start underwriting. And you can say like, it's going to affect valuations. I don't care. Like, who cares about valuation? Valuation is like a mark in time. But like, I do care about capital going into these companies because capital pays people's salaries. Capital lets you hire. Capital, buys compute. Capital builds product. And I think one of the first effects people are going to start seeing, and I'd argue they're already seeing today, is that there's plenty of capital still out there. But capital is really getting focused in the stuff that like seems safest, the highest flyers, the very best in the category leaders. And if you're not quite perfect, it's going to be a lot harder. And if you're just good and not great, capital may not be available to you. And it's going to really start affecting entrepreneurs and people, even though they're doing a pretty good job and building real companies, people are going to hit a capital wall and not be able to raise, across the stack. You've seen it with a couple high flyers that were a little bit more hype than substance, like the Fasts of the world, who kind of went out of business last month very abruptly, very quickly, primarily because they thought they had it in the bag. They thought they had access to near infinite capital, and very quickly it wasn't there. I think you're going to start seeing it throughout the life cycle. Seed, Series A, B, C. It's going to hit every stage.
Definitely. So this question is called 3 data points. I'm going to give you a hypothetical situation with a startup, and you can ask 3 questions for 3 specific data points. Let's say your approach to invest in a seed stage consumer marketplace startup. The company is based in San Francisco. The sector is e-commerce. They're generating $50K in monthly GMV, and they're growing 40% month over month. Again, the catch is you can only ask 3 questions for 3 specific data points in order to make your decision. Which 3 questions do you ask?
Oh, man. This is a good exercise. The first one would be talking about like the supply side, because it's what I'm focused on, which is why are you different? Not why are you better? Why are you different? Like why is what you're doing different and why not? And that's 2 questions. I was trying to sneak in like 2 or 3 at the same time. That would be number 1, just to be like, hey, do I think is it interesting? I'm first and foremost, I'm looking for these big and novel new marketplaces. Number 2 is like, why you? Like, why was this team placed on earth to come together to do it? And that one, I probably secretly would ask about 75 different questions in there to like really figure out why this team was placed on it. And so those really would be 1 and 2. I don't even know if I need a third. You told me like it's growing plenty fast. It's in my backyard so I can shepherd it. Like I only need 2.
Awesome. All right. If we could feature anyone on the show, who should we interview and what topic would you like to hear them speak about?
That's a good question. There's some people, I think earlier in this podcast, I kind of mentioned that I have this huge affinity for the thinking of Bill Gurley and Mike Maples. I've kind of always looked up to them. And so it's like, who of my generation or the generation below me is going to be the next great thinker and inventor? And, the people that whenever they write something or whenever they say something, I like really stop and listen. Would be like a Sarah Tavel at Benchmark. I just think she's an immaculate thinker. He can be a little controversial sometimes with his Calendly quips, but like Sam Lessin at Slow Ventures is a special thinker. The systematic approach of Nikhil Basu-Trivedi at Footwork is pretty special. And then there's like this modern cultural kind of who's at the center of the VC's zeitgeist, like a Logan Bartlett or Redpoint, who's like really changing the game of how you source and how you kind of build your reputation in venture with his shit posting and memes, because there's like some methodology behind the madness. Those types of folks all have very thoughtful long-term plans of how they're building their careers.
Definitely. Do you have any tools or hacks that are a secret weapon?
Yeah, that's a good question. I actually have gone the other way. Everyone's trying to make their lives more efficient, which who doesn't, right? I've actually tried to carve more time that doesn't involve tools and hacks. My answer to that question is always cast iron pans, because they're like intentionally slow. And I spend a weird amount of time like making my children hot breakfast every morning and then like taking the time to properly clean and oil my cast iron pans, because it almost focuses me to slow down. And it's like slow down to clear my mind so I can speed up throughout my day. You know, this is not an output game venture. This is a be smart. Like one smart decision can make your next 10 years. So get yourself in the right mentality to make that one smart decision.
What's the go-to breakfast?
You know, it rotates pretty regularly. You know, French toast, pancakes, cinnamon rolls, scrambled eggs, Dutch babies, which is kind of like a pop-over pancake.
Full service over there.
Yeah. You know, it's not like I have one cast iron pan. I always got the bacon and sausage going on the other burner. It was a COVID kind of new behavior, but that I keep on extending because it's an important part of my day to spend that time with my children and clear my mind.
And what's the best way for listeners to connect with you?
You know, they can reach out to me, Tripp, Tripp at uncorkcapital.com, DM me on Twitter. You know, I'm more of a voyeur than a poster, or reach out to someone that knows me.
Awesome. All right.
Cool. Thanks, man.
Yeah, that was great. Appreciate the time.
That will wrap up today's episode. Thanks for joining us here on the show. And if you'd like to get involved further, you can join our investment group for free on AngelList. Head over to angel.co and search for New Stack Ventures. There you can back the syndicate to see our deal flow, see how we choose startups to invest in, and read our thesis on investment in each startup we choose. As always, show notes and links for the interview are at fullratchet.net. And until next time, remember to over-prepare, choose carefully, and invest confidently. Thanks for joining us.